Um, Anyone else? Any other question about that?
Professor, are we going to be using the whole 3 hours then for this class, or is it going to be a shorter class since we're doing the lecture through the video that you posted, which was almost 2 hours, I think, correct?
Yeah. Yeah, man, you're a little low, but I can hear you, but you're a little low. I'm not sure if you're away from your speaker or you want your mic or something. But yes, it will be a shorter class because what we're doing is it's breaking it up into two. So the lecture will constitute an hour or two, and the tutorial will take the other portion. So the two together should give you your 3 hours for the week.
Okay, perfect. Thank you.
Anyone else? All right, so so the video was posted last week. We will go through that after, but I just gonna take some time and go through the course outline and some of the things that we will be covering during the semester. I hope you guys have already gotten a chance to look at some of the stuff. All right, so the course outline here, financial and managerial accounting. The text for this course is Foundation of Financial Management. It says here that the custom version, but this is not available, so we're using the full version of the text that is McGraw-Hill published. I have already posted instruction as to how you can go about purchasing the book. We are not going to use the Connect Labs, so there's no need to purchase access to the lab. I am going to try and do it differently rather than you guys having to go purchase access to the lab. But you can try and get access to the online version of the text. All right, so this week we're going to try and cover elements of financial statements. And then next week, we are going to look at financial statement analysis and discuss the need for interpreting of financial statements and calculate some basic financial ratios and look at how we would interpret those ratios. Then we're going to move on to look at financial planning and forecasting, and then operating and financial leverage and profitability analysis. Then we looked at working capital and the financial decision. Then we look at current asset management and sources of short-term financing. So as you can see here, let me just on my weekly schedule, it shows you how we will be covering these topics. So week 3, which is next week, we'll be doing financial statement analysis. Then on week 4, we'll look at financial planning and forecasting, and we will go into week 5 with that. Week 6, we will look at operating and financial leverage, and as well in week 7. And week 6, we'll have an assignment for 10%. That's our first piece of assessment. Then week 7, we'll have our first test, and we're going to do 3 tests for this course. We're going to have the first one on week 7, and it will cover chapter 2, 3, and 4 before we go off for the student success week. That's for 25% of your grade. So when we return, we will look at working capital and the financing decision as well. That's week 9 and 10. And then in week 10, we'll also do a second test, which would be covering chapter 5. That's for 10%. Then in week 11, we cover current asset management. Week 12, we finish up current asset management, and we do test number 3, which would cover chapter 6 and 7. And then in week 13 and 14, we finish up with the rest of the semester by looking at short-term financing. And of course, the final exam will be. So there will be, for evaluation purposes, there will be the assignment, 10%, then test 1 for 25%, test 2 for 10%, test 3, 25%, and then we'll have a final exam for 30%. Any questions so far?
Yeah, can we, a clarification, because you have it there 15 weeks, but on the Conestoga calendar, it's a shortened semester. So just for the first assignment, you have it as week 5, I believe.
Week 6, week 5.
Week 6?
Week 6.
Week 6.
Mm-hmm.
What date is that? Are we moving everything backwards? Because you have week 8 being success week, but it's actually week 7 the success week is.
Is that so? Have they changed the calendar? Because I when I was making my schedule, I looked at the calendar, unless they have changed it since I have.
We are all under the impression that it's a shortened semester, and that's what our prof said previously.
I can't hear you. Can you speak a little louder?
We are all under the impression that it was a shortened semester, and that's what Jim communicated to us.
Okay, so was that given to you in a calendar or just? I can check this again just to make sure. I can check it again just to make sure that my dates here are correct. But when I was making the schedule, I looked at the current Conestoga schedule, and it was as I saw it. Okay. So I'm not sure if it has changed since. I know that there was I've heard it that's been said that there may be looking at 6 and 7, so 13 weeks of teaching. But I didn't receive an official thing, and that wasn't on the official calendar either. So, but I can recheck it.
Was last week 1 or week 2?
That's
Pardon me?
Was last week 1 or week 2?
The last week, so I set it to make sure that it runs pretty similar to the start of the school year. So since the semester started last week, I set last week 1 to be last week.
Okay, so then student success week would be week 7.
Okay. All right, so I also have an instructional plan that gives more detail. All these things are already posted for you guys. You can always download them and make sure to put them in your file.
Professor, for the tests, are we going to be using online tests like we did for our other course with you with our economics course?
Most likely that's how we will be doing our tests. I can't see it be different right now, so yeah, I would say yes.
Okay.
And then, Professor, just wondering what's covered on the final exam then, because it looks like there's a test 2 weeks before a final exam.
There's probably a test, yeah. I think there's a test week. There's a test on week 12. And then the final exam will be on week 15. So you were saying?
Yeah, will the final exam just cover short-term financing then?
No, most likely the final exam will cover most of the stuff that we'll be doing after the success. But I'm not confirming that yet. I will confirm that closer to the time. But you can. The idea behind it right now is that most of the stuff after success week will be covered in the final.
Oh, okay.
Okay. Anyone else? All right. So okay. So I have instructional plan here as well. So you guys can take the time and go through it. It will give more details, and it tells the exact dates of your test. For example, the first test will be on June 22nd, and number one will be June second. Your assignment June 15th. Test June 22nd. Your second test will be July 13th. Your third test will be July 27th, and then we have a final week, which is week 15, will be the week of August 17th. So all the details are here in your okay. Any question with regards to any of those?
I think so.
Okay, I take silent to mean no. All right, so this week lesson will be an accounting review where we look at 4 major financial statements: income statements, balance sheet, statement of retained earnings, and the statement of cash flow. So the video was posted. I hope like most of you guys have gotten a chance to go through it and to at least understand some of the things that were included. So is there any question with regards to anything that were posted here that you guys went through it, didn't understand, would like me to go back over before we look at the questions? Is there anything that you would like me to explain that you weren't able to hear it well, you didn't understand what it was saying, or anything that I could go back and cover here for you right now as I have presentation. So that could mean either one of two things: is either that you're very clear on everything, or that you didn't get a chance to look at it yet, which in that case, you should probably make sure to take time out to look at it, because it's important that you cover the material. Because in breaking it up this way, it would be good for you to be able to do at least go through the presentation, watch the video. Then when you come to class, we are able now to do the questions, and it helps you to solidify anything that you have learned before, or to clear up anything that you have done and seen in the video or in the slides but didn't understand. So it's important that you do that, because I can assure you that if you do the work in this course, you will pass. Yeah, but if you don't put in the work in this course, I'm not sure if you will. So it's up to you. If you do the work, if you put in the work, if you put in the effort, you will be reflected in your grade. All right. So no question with regards to this. No question with anything you guys want me to go over with regards to the slides. You didn't understand it from the video lecture, and you think I should probably do. All right. So I think that you all understand that. So therefore, we'll just move on to look at the questions. The questions were also posted. The first one says, Bradley Bus Inc. had earnings last year of 600,000 with 300,000 shares outstanding. January 1 of the current year, the firm issued 40,000 new shares. Earnings after tax increased by 25% over the last year. So it says A, calculate earnings per share for last year. Okay, so the question tells us what was last year's earnings. It said it was 600,000, and tells you that there were 300 shares outstanding. So that means the number of common shares of Bradley Inc. that were issued and outstanding would have been 300,000, and it tells you the earnings. So it's now simple mathematics, right, to find what would be the earnings per share. Because the earnings per share would equal to earnings divided by the number of shares outstanding. So in this case, earnings per share would represent 600,000 divided by 300,000 shares that are outstanding. And earnings per share would be $2. Right?
Yeah, just $2.
$2. Earnings per share would be $2.
Are you writing on the screen right now?
No, I'm not. You'll let me to write it? I can write it. That's okay.
Okay.
Okay, so with this, we have earnings. Earnings after tax of 600,000. And we have shares outstanding.
So then we have like 750,000 divided by 340 shares, correct?
Yeah.
All right, so
the
$2.20.
earnings per share, let me just finish this one, would be 600,000 over 300,000. $2. So that's for A, and B, as you were saying, was that Kieran?
Yeah, it ends up being like 220. You take 600 then multiply by 1.5, 750 divide by 340, you get 2.2.
Yeah. Everyone gets how he did that one? Okay. Otherwise,
I think you went quiet there.
yeah, I'm just trying to. Can you guys see my screen? What are you seeing now?
Just the
I still
previous
see
question.
the previous question.
We see earnings per share is equal to $2.
All right, I'll just do the next part here, but I'm not seeing it. It's not showing on my screen. Well, I'm just gonna clear it. I hope. Is there anyone writing? Can I clear the screen?
Pretty clear.
Go ahead.
Oh, it's already clear. Okay. So EPA. So in the second case, the question tells you that the share. It says on January 1, the current year, the firm issued 440,000 new shares. So therefore, shares outstanding would be 340,000, right? So that's 300,000 plus 40,000. And it also says that the earnings after tax increased by 25%. So therefore, earnings after tax equal to 100,000 multiplied by 1.5 or 125%, whichever one that you're okay with. That should give you 750,000. So we can find earnings per share as 750,000 over 340,000. That should be around $2.21.
Are you writing out the next question? Because I'm not seeing it on the shared screen.
Can you see it now? Are you seeing it now?
Yeah, we can see it. Thanks.
Okay.
Hey, sir.
Hello.
How come we are adding
Your background is pretty. I think you're
the
having a
company is
feedback.
issuing it? Aren't they selling it to the
Who's that
investors?
talking? Who's that talking? Who's talking? Huh? I'm just trying to identify the person.
Seth Aguiar.
Huh? I didn't hear you. Can you say again?
Yeah, I was wondering why we're adding the 40,000. If they're issuing it, wouldn't they be taking that from the reserves and selling that back to the investors?
Okay, so remember what we're calculating. So what we're calculating is earnings per share. So it's the number of shares outstanding, the number of shares that were issued by the company to investors. And those investors include all shareholders, like that could be also like board of directors, they may own shares. So the company initially had 300,000 shares issued to those investors, right? So it now issued an additional amount of 40,000. So therefore, that's why it is added to the 300,000. So even if the company, the number of shares that is accounted for when you're doing earnings per shares is the number of shares that are issued. outstanding. So even if the company, when it was doing its article, is declared that it will have, say, 2 million shares, but if it did not issue those shares would not count as part of the shares issued and outstanding, and therefore would not come into the calculation of your earnings per share. So only shares that come into the calculation of your earning per shares is the shares issued and outstanding. So in this case, the additional 40,000 were issued and outstanding, so they'll be added to the 300. Okay?
Okay. Yeah. Thank you.
All right, so let's look at question number 2. Question number 2 is similar to question number 1. It asks, says Dover River Company has current operating profit of 200,000 for tax. Increase expenses at 10,000, dividend paid and preferred shares 18,700, and common dividends paid is 30,000. The company paid taxes of 61,250. The company has 20,000 outstanding common shares. Calculate the earnings per share and the common dividend per share. Class A, and B asks for the pivot ratio. C, determine the increase in retained earnings for the year. And D, if the share price is 26, calculate the price earning ratio. So we can start by calculating the earnings per share and the common dividend per share, right? So it tells you that it has an operating profit of 200,000 and interest expense of 10,000. So we can do a mini income statement. River. Operating profit. Operating profit. And what's another name for operating profit? What's another name for operating profit, guys? Anyone? Andrew. What's another name for operating profit?
Is that revenue?
No. Okay, so it's
Net income.
earnings before interest and taxes. So if you go back and look at our income statement that we as in the slide, you will see that operating profit is also called earnings before interest and taxes. Okay. So if we add interest to this, we're gonna take interest expense. Take interest expense from our earnings before interest and taxes. In this case, our interest expense is 10,000, right? So if we take interest expense, we have 90,000. And so what is this called? What is 190,000 called? Called earnings
Before taxes?
Earnings before taxes. So earnings before taxes is 190,000, and then we have taxes. And taxes is 61,250. So we now have earnings. Right. What kind of earnings do we now have? Earnings after taxes. So earnings after taxes would be 128,750. That's an E right here. I'm doing a bad job at this E. Earnings after taxes would be 128,750. Okay. What next do we have? Not functioning well at all. Okay. We have, what next do we have? We have preferred dividend, right? We have, so we're gonna take out our preferred dividends. Less than preferred dividend. And when we less preferred dividends of 18,750, we now have the amount available to, so earnings available to common shareholders of 110,000. So that's our earnings available to common shareholders. I'm having problem writing on this. This thing is giving me some trouble. So the 110 there represent earnings available to common shareholders. So I'm just gonna switch over to another page and write here, earnings available to common shareholders would be 110,000. So now that we know what the earnings available to common shareholders, right, we can also find common, we know what the dividend is for the common shareholders. If we take away the dividend from here, so common shareholders dividend of 30,000, we have 80,000 that represent, what would this represent? What would we do with the 80,000? So we pay our, we have earnings available to common shareholders of 110. Then we have dividends of 30,000. So what would we do with the rest? Anyone?
Split them up evenly to the shareholders?
Kiran, can you speak a little louder? You're kind of very low when you talk.
Split them up evenly to the shareholders?
Well, that's what a dividend is, right? The dividends is what we're giving to shareholders. So the remainder is 80,000. So what do we do with the 80,000? So the 80,000 is what is called retained earnings. So this would be added to the previous year's retained earnings and be shown in your balance sheet as part of your capital. So the 80,000 represents what is called, say this would be increase in retained So first thing is our earnings per share, we know would be 110,000, which was the earnings that was available to common shareholders. And then we will divide that by the number of shares outstanding. In our case, it's 20,000. So our earnings per share should be around $5. How about our dividend per share? The dividend per share would be the amount that was paid out for dividend divided by the number of shares outstanding. That should give us about $1.50 per share. The dividend per share will also tell you how much each shareholder will get. So if I have 10,000 shares, for example, then I would receive 10,000 times 150. Okay, so what was the second part of the question?
Calculate the payout ratio.
All right, so we're asked to find the payout ratio, right? E was for the payout ratio. What is the payout ratio? The payout ratio would be what? The dividend per share over the earnings per share. Earnings per share. So in our case, the payout ratio would be $1.50 over $5.50, give us 27.27. So another way you could do it is by doing the dividend divided by the earnings available to common shareholders. So if we do dividends by earnings available to common shareholders, it would be 30,000 over 110,000. And that should also give you 27.27%. As for B, C is asking us he asks for what's the increase in retained earnings, right? And we have already found that number when we did the statement. We said that increase in retained earnings was 80,000. And then D, asking for the price earning ratio. Price earnings ratio tells you how much multiple of your earnings earnings per share is actually your price. So the price earning ratio is equal to the price of the stock divided by the earnings per share. So price over, and in our case, it would be $26.40 over $5.50, represent 4.8 times. So in other words, the stock is trading at 4.8 times its earnings per share. Okay, any question?
If you were a company, would you want a relatively lower PE ratio?
From a company's perspective, it doesn't really matter. But from an investor's perspective, earnings per share, it tells you how much the stock is trading given its current price. And one of the reasons why some earnings per share tends to be so high is because of future earnings. So if investors think that the company will be doing well in the future, then they will actually drive the price up, and hence its earnings per share will go up. So it's more like an indicator of how well investors are thinking that the earnings of the company will be.
Okay, yeah, that makes sense. Thank you.
Professor,
Yeah.
would you be able to explain what the 4.8 means again, please?
So the 4.8 is telling you how much what's the multiple of the earnings per share is the stock trading. So in this case, in our case here, we have earnings per share of 4.8. So I'm telling you that that the company's price, the price of its stock, is 4.8 times its earnings per share of $5.50.
Okay, thank you.
Okay, so any more questions? All right, let's have to.
Professor, so would you want a high PE or a low PE then?
Okay, so depends again. If you're an analyst and you're looking to invest and you have looked at this company and company's statement telling you that this company is good overall, but its PE is low, then it may have an opportunity to buy, right? If a company has a high PE, but nothing else none of its other fundamentals is great, then you may not want to buy that company because it's already telling that it's trading at high multiples of its earnings per share. So unless there are potential great earnings there, then you're not going to want to buy that company. So that's what you're getting. So if part of what earnings per share does, I'm saying earnings per share, price earning ratio, it gives you an indication as to how investors feel about the stock. So if it's high, if I'm an analyst and I analyze this company, I look at different aspects of it, and I don't like those fundamentals. If the earnings per share is high, I'm not going to buy it. Or if I'm just okay with those fundamentals, if the earnings per share is high, I'm not going to buy it. Keep on saying earnings per share. Sorry, the PE ratio. The PE is high, and I'm not going to buy it. And the reason why I won't buy it if the PE is ratio, because I'm not seeing that potential for future growth. And it's already trading at high multiples of what it's actually earning now. If that earning per share is low and the outlook for that company is good, then that's a potential good investment. So I wouldn't just trade on just the earning per share, but it would be one of the, I'm saying earning per share, on the PE, the price earning, but it would be one of the indicators that I would look at when I'm deciding on a trade. Okay, make sense?
That's perfect. Thank you.
Good. All right, so let's take a look at the next question, which is question 3. It says Far East fast food has earned after tax of 230,000 in 2018, 20,000 shares outstanding. In January 1, 2019, the firm issued 30,000 new shares. Because of the proceeds from these new shares and other operating improvements, earnings after tax increased by 25%. It says compute the EPS for 2018 and 2019. All right, given that we've gone through the first two and you guys have gotten the idea, even when we have gotten them from over the weekend. So I'll just leave you to do these two. I'll give you 5 minutes.
Everyone's probably done by now. I am.
You're finished with both parts of the question? A and B?
Yeah, it's identical to question 1, basically, except the numbers.
Let's just give the others another minute. All right, guys, you all finished?
Yeah.
Yeah.
Yep. Yeah.
Okay, so what's the answer?
I got $1.15 for A and $1.25 for B.
Okay, those sounds like good answers.
I got a $1.20 for B.
$1.20 for B.
Oh,
What
I
did
think
you-
I screwed up. Oh no. So it's 230K times 1.25 divided by 200K plus
So
40K.
I'll just share mine.
Oh.
I'll just
So
show what
40
you
or
guys are
30.
doing. So you can see how I've gotten, for anyone who hasn't able to get the correct answer, come up with the correct answer. So in the second part, which was, the any part was difficult, not really difficult. In the second part, you just have to make sure that you increase the earnings, after tax earnings, by 25% to 87,500. And then the number of shares were increased to 30,000. So we have an EPS of 1.25.
Yeah, that's correct.
All right. Anyone else? Anyone? All right. No question with regards to that. Let's move to question 4. And in question 4 here, says Sheridan Travel had earnings after tax of 600,000 in 2018, with 300,000 shares outstanding on January 1. The firm has 40,000 common shares. There is 25% increase in after tax. So this question is pretty much a mirror of the one before. So you guys can work this one out. I'm not even going to bother to do it, but I'll just give you the answer anyway, so you can. But it's the same as the previous question, so there's no need for me to actually work it again. Just let you know what answers are. For this one, it would be just right answers right here. EPS $2. Here, EPS would be $2.21. That's what you're supposed to get when you work this one out.
I got that, yeah.
Okay, so let's move on to question number 5. Unless someone has a question with regards to 4. All right, let's move on to question number 5. Botox Financial Care had earnings after tax of 370,000 in 2018, 200,000 shares outstanding. The share price was $31.50. In 2019, earnings after tax increased to 436, the same 200 shares outstanding, and the share price rose to 42. Compute earnings per share and the PE ratio for 2018, and again, the same thing for 2019. And then it says, give general explanation of why the PE ratio has changed. All right, so 5 minutes, guys. Take a shot at it. Guys are done?
Just
Yep.
Yep.
yeah.
All right, so let's see. Okay, so for the first part, I get earnings per share of $1.85. That's what you guys get. Huh?
Yep.
And the PE ratio, 2018, $31.50 over 5 cents. We have 1.703 times. And for B, so for B, the earnings per share, EPS, that's 2019, would be, I'm just going to write the answer again for you guys. And 8, they have a PE of 19.49 times. Okay, so in C, we have to explain why the PE changed. The price increased by 34%. So we have a 34% increase in the price, while earnings per share only increased by around 17%. So that change would be what caused the change in the PE. Remember, the PE is just price divided by the earnings per share. So those are the two factors that are going to affect.
So, Professor, is it better to have a higher PE ratio, or is it better to have a lower one?
Okay.
It matters if you're investing, not really if you're the company.
Right. If you're the company, it doesn't matter. If you're talking from a company's perspective, the only reason why the company would be concerned with its PE is if it's looking at what would be its share price. That how much, because remember the objective of word I'm looking for again. So let's say the objective of say the finance manager is to maximize the shareholders' wealth, right? So in maximizing shareholders' wealth, you want to maximize the share price. So from that perspective, the financial manager may be concerned with taking looks at the earnings, the price earning ratio, but it doesn't affect the company. It doesn't have any impact on the company. But as an analyst, you sometimes look at this to see what you're anticipating, what you're thinking investors are thinking about the company. But from an investor's perspective, you would look at your earnings per share as one of the factors to consider. Now, the higher the earning per share, it usually indicate how investors see the stock. See the stock as having future earning potential. The higher it is the stronger they are thinking that earning will be. However, many a times that's not necessarily true, and a lot of times the price of the stock gets driven up by speculation. It's not supported by the underlying. So many a times these stocks are overbought because they have such high PE. A low PE could be an indication that the stock, the potential for future earning of the stock is not good. Hence, as an investor, you may not want to be holding on to that stock because the potential for it to grow is not good. But those are things that you would look at. So the PE would give you an indication. Then you'd have to go and do the underlying work to see if that stock is a good stock to buy. So high or low PE is just an indication as to how investors feel about the stock. Answer your question?
Yeah, thanks.
So as a company, though, investors to feel good about your stock?
I think I missed part of your question. It didn't come through properly. Can you repeat?
Yeah. As a company, though, if the P/E ratio is a measure of how investors feel about your stock, wouldn't you want them to be confident in your stock?
Well, you're always happy to have higher prices, right? So remember, one of the things about a PE is that the higher PE is, it means that the higher your price is relative to your earnings. So you always want to have higher prices. And so you may be happy that investors feel good about your stock, but it doesn't have any impact on how you run the company. So it wouldn't affect anything with regards to your earnings. It wouldn't affect how your banks feel about it. So if you need to go to the bank, for example, to see borrow money, to take out a loan, your bank would not be interested in your PE. There will be other factors that would come far ahead. Okay?
Yeah, that makes sense. Thank you.
All right, so let's move on to question 6. In question 6 here, it says Aztec book sold 144 1,400 finance texts to High Tuition College for $84 each in 2018. These books cost $63 to produce. In addition, Aztec Books spent $2,000 selling expense to persuade the college to buy its books. Aztec Books borrowed at $50,000 on January 1. So it borrowed $50,000 on January 1, 2018, and which it paid 10% interest. Both interest and principal were paid on December 31st, 18. So he actually repaid the loan on the 31st of December. So he kept it for a year. So Aztec book tax rate is $20, 20%. Amortization expense was $5,000, and it says the Aztec book make a profit in 2018. Verify your answer with an income statement presentation. So this question is basically asking for an income statement, and using that income statement to show whether or not a profit was made. Okay. So And underline that much. So income statement. As for the year ended December 31st. And 8, right? So what's the first thing we're going to put in our income statement? What's the first thing we always start off with in our income statement? We'll start with sales, right? Don't sell anything, can't have an income statement. So in this case, we have 117,600. And then what's next? What's usually comes next in our income statement? So usually we're going to have, so take from sales the cost of goods sold, right? In this case, we know that the cost of goods sold would be 28,200. And therefore, taking sales, taking cost of goods sold from sales, we produce what? What do we produce? So what comes next here?
Net profit.
Net profit? No, net profit would be pretty much the last thing, right? So net profit would be actually what we have been calling what? Earnings that are available to common shareholders. So net profit would be what we have been referring to so far as earnings available to common shareholders. So here it would be some form of profit, but no, net income would be the same as net profit. So here it would be
Gross profit.
Yeah. So this would represent gross profit. Remember, net profit is the last thing we produce in our income statement. Right? Net profit, net income, same thing. Same thing that we refer to as earnings available to. Okay, so we now have our gross profit from which we will take what?
Selling expenses.
From which we will take selling expenses, yeah.
And the loan.
But we don't reach a loan yet, right? I'm gonna take selling expenses first. Selling expenses of 2,000. We're not yet at the loan. What else are we going to take from this? What are we aiming to get? What's our aim? What's our objective in finding here? Our objective in finding is operating profit, which is also called earnings before interest and taxes. So we're not interested in interest and taxes as yet. They will come after. So here is amortization of 5,000. So we take our amortization and we take selling expenses. So that means we have 22,400. This would be our operating profit or what? Earnings before interest and tax. So from this now, we're going to take our interest expense. And our interest expenses 5,000. And this represents our earnings before taxes. The taxes would be 3. But taxes is what? 20%, right? So the 20% of 17,400, that will be 3,480. So earnings after tax would be 1,392. Yeah, go ahead. Kiran, you asking a question?
No, sorry.
All right, is that clear to everyone? Okay, I assume that when you guys don't answer, you mean yes, it's clear. So,
Sorry, Professor. Oh, I'm just wondering about the interest expense. How did you get that number? The 5,000.
Interest expense, 5,000?
Yeah.
Okay, so let's go back to one question.
So just the 10% times the 50,000?
Right, so he borrowed 50,000 and the interest on that is 10%, right? Yeah, it says on January 1. And so this question is set up for it to be easy, right? So the question tells you that he borrowed the money on January 1 and he keeps money for the entire year. So he's gonna pay 1 year worth of interest. That one, and the rate of interest for that year is 10%. So hence, all you have to do is find 10% of 50,000, which would be 5,000. Okay?
Yep, that makes sense.
Professor, I just had a question. Actually, it goes back from when I watched the slides. Just like, could you explain a bit more about amortization? Just like a definition.
Amortization?
Yeah, just a quick definition.
Okay, so amortization is depreciation. So when a company buys an equipment or it builds a plant, it has a number of useful life, right? So if a company, let's say the company buys a piece of equipment, a generator, standby generator, and it costs, say, $1 million. The company would not want to have to write that $1 million off, and it would be reflected on its profit in year 1. So what the company will do is to try to spread the cost of that $1 million over a number of years. So it will determine what the useful life of that asset is, of that standby generator. So let's assume that it says it will be for 10 years. Let's assume that it wants to depreciate it equally. This is an assumption. Again, the company will decide on its own accounting policy. And let's say the accounting policy is that it wants to depreciate this equally over those 10 years. So what the company will do is to amortize that. Since it's $1 million over 10 years, that would be $100,000 per year. So the amortization based on that equipment would be $100,000 every year. That would be the amortization.
Okay, so it's just another way of saying the depreciation value.
Yeah.
Okay. Okay. Thanks.
All right. Any other question?
I have one. Why do we not account for the loan that we borrowed at all?
And in accounting for it, you mean you're not seeing it in our income statement? Huh? Is that what you mean, Ethan?
Yeah, the 50,000 doesn't appear in any of the equations, so I'm just wondering what happens there.
Okay, so the question did tell us that we repay it, but it didn't tell us where to. It didn't have any effect on what we were doing, because in repaying the loan, the loan itself is not an expense, and the only thing that goes into your income statement is expense and revenue. So if the item is not an expense item, or if the item is not a revenue, it will not be in your income statement. So the loan itself was not an expense. Even when the company repays the loan, it will not be in the income statement because it's not an expense. The income statement consists of expenses and revenues. Item is not an expense item. Item is not a revenue. It will not be in your income statement. So with regards to the loan, the expense on that loan, cost to that loan would be the interest. Hence, the interest is shown in the income statement. The loan itself, if we were to do a balance sheet, for example, or if we were to show our T account, then we may show when the loan is transferred from, say, cash or from one bank account to the other. But we weren't asked to do any of that. We were just asked to produce an income statement. An income statement doesn't include anything that's not expense or revenue. So what would be the loan represent anyway? Ethan, what would the loan represent?
It'd be a positive cash flow into the company.
There would be a positive cash flow. But in terms of an item of a definition for what is the loan? What's another word for a loan? When a company borrows a loan, what is it to that company? I know you had produced positive cash flow, but what is it called? It's a debt,
like
right?
Accounts payable.
It's a liability. So liabilities and assets are in our balance sheet. So in our balance sheet, we would see where the debt would, if we should look at two separate periods. Let's say we produce a balance sheet for January 1, then we would have shown a liability of $50,000. Then if we produce the balance sheet for December 31st, then we would have shown that the balance, that the liabilities or the debt would have been decreased by 50,000. So that's how we would have actually seen it. But we didn't produce a balance sheet, so hence it didn't become relevant to the question. The only relevance of it was that it helps us to calculate what the interest is.
Okay, thank you.
All right, let's move on to question 7. This is car wholesale had sales of 900,000 in 2018. Cost of goods sold represented by 65% of sales. Admin expense were 9% of sales, and amortization was $10,000, and interest expense for the year 8,000. The firm tax rate is 30%. Compute earnings after tax using percentage of sale method. All right. So again, this question is not very difficult. Not because you see it says stuff like percentage of sale and that. It already give you all that information. Hence, we just have to produce a simple income statement. Okay, so, all right, by now we know what we start with, right? We're gonna start with sales. We know sales is 900,000. Then we have cost of goods sold. And you know it is at 5. It should have been 65, right? So 65% of 900,000 because it's 65% of sales, 485. So we produce gross profit next. We have selling and admin. And we say that's 9%, right? 9% of sales. So 9% of 900 would be 1,000. And we have amortization. Amortization expense of 10,000. So we produce earnings before interest and taxes of, or another name for earnings before interest and taxes would be
operating profit.
Operating income or operating profit. Then we have interest expense. We have interest expense of 8,000. So therefore, earnings before taxes earnings before taxes are taxes of 216,000. Taxes are at 30%. 30%. 4,800. So after tax earnings, after taxes would be 151,200. 151,200. Okay. All right, let's see you guys try the second half of that question.
Can you just leave that screen up for a sec?
Sure. You guys finish?
Yeah.
Yep.
What's your earnings? What's your after-tax earnings?
We got 178,500.
Good. After taxes. Okay, so everyone can see mine, right?
Yep.
All right, let's move on. Let's move on to question 8. All right, is there anyone who would like me to explain anything on what we just did? Before we go to
The
question
answer,
8?
the answer we should have got for that final thing was 17 or 17,850.
Yeah, 178,500.
All right, cool. Thank you.
Okay. Okay, let's move on to question 8. Thermodynamics. Question 8 here. It asks, thermodynamics had $450,000 of retained earnings on December 31st. The company paid dividends of $25,000 in 2008 and had retained earnings of $400,000 on December 31st, 2017. How much did Therma earn during 2018, and what would the earnings per share be if 20,000 shares of common stock? So it tells us what the retained earning is at the end of December 31st. It also tells you what the retained earning was on January 1, 2018, right? Because what it is, what it was on December 31st, 2017 would be the opening retained earnings for January 1, 2018. The January 1, 2018, the retained earning would have been 400,000. And on December 31st, 2018, it would have been 50,000. So in that case, how do we find what the earnings was? What does the retained earnings represent? Anyone? What does retained earnings represent?
How much is left after you pay all the stocks?
How much wait after you pay all the stocks? Can you elaborate on what you mean when you say after you pay all the stock?
So it should be it should be like the gross earnings, and then you do the interest and the taxes, and then you pay out the preferred dividends and then the common dividends, and it's like whatever you have left.
Earnings available to shareholders minus your common dividends.
Okay, so you're onto something, but you're probably a little bit. Okay, so let me go through retained earnings. So technically speaking, dividends, common dividends are paid from retained earnings. Technically speaking, common dividends are paid from retained earnings.
Now, what is retained earnings? So I have been operating business for say 10 years. Every year I make a profit and I will distribute some of that profit to my shareholders, then I keep the rest. That rest that is kept is called retained earnings. So retained earnings would accumulate every year if the company is making a profit. If a loss is made one year, that loss would go towards reducing retained earnings. So retained earnings is accumulated profit. Accumulated profit, what is retained earnings. So usually, dividends are actually paid from retained earnings. So technically speaking, that the profit available to common shareholders is added to retained earnings, and then from retained earnings, the dividend is actually taken out. That's how it should actually. We sometimes like say you take it out of a profit, but it doesn't really come from the profit directly, actually from the retained earnings. The profit itself goes into the retained earnings, the dividend is taken from the. Okay? So given our new understanding of retained earnings, let's see how we can approach what they're asking us. Dynamics, and we know that retained earnings on December 31st, 8, 450.
If you're
Can't
right.
see what you're writing.
Can't see?
No.
No.
Can you see it now?
Yep.
All right. All right, so we have retained earnings from December 31st of 450,000. And if we take from this, the retained earnings, of December 31st, or you could say January 1. So let's say December 31st, 2017. First 7 of 400,000. Right? Take that away. We have what is the change in retained earnings. So this would be the change in retained earnings in 2018.
2019.
Of 50,000, right? That's the change in retained earnings. Now, we know that we paid dividends of, the company paid dividends of 25,000. So if we add dividends that was paid, $5,000. Therefore knows that their earnings payable to common shareholders 750. So that would be what's asking us for. That would be our earnings for the year. So if you look at it, in earning, you started out the year with 400,000. Then the company would make a profit of 75,000, right? Right? See, we have 75,000 there. So if you add that, that would be 475,000. And if we take away the common dividends of 25,000, we have at the end of December 31st, 2018, retained earnings amount of 450. Okay? Okay, guys? Yes, no, not sure, maybe so.
Yeah, we're good.
All right, let's see. D. And all these asking us now for, now that we know what the earnings is, asking us now for what the earning per share is. And we know that earning was 5,000. And we will divide that by the number of shares outstanding of 20,000. So that gives us an earning per share of $2.75. Check that to make sure. C, payout ratio. Payout ratio would be what? Represents the dividend that was paid over earnings for the year, and that would be 0.0. And for D, P ratio, D, for $30 per share stock price over the earnings per share of 375, that gives us about 3.0. Right. Any question?
No.
All right, let's finish up. Let's finish up by looking at this balance sheet for question 9. And we're given some numbers and we're asked to put them into a balance sheet. It says arrange the following items in proper balance sheet presentation. Accumulated amortization, retained earnings, cash, bonds, accounts receivable, plant and equipment. All right, so let's go through this quickly and identify what we think is and where it is going to go. So where would amortization go?
Wouldn't our cash be first?
Right, so cash would be first, yeah. I'm just kind of like going down the list and asking you where you think we'll put these items. So since amortization is at the top, that's the reason why I'm starting at the top. Where would amortization go? Accumulated amortization. So the accumulated amortization is the accumulated amount. Remember when we said when you depreciate the assets over 10 years, each year you would write off, say, 100,000. That 100,000, so that will go into the income statement. The accumulated amount, which means every year that's 100, 100, 100,000, would be what we're looking at here. So the accumulated amortization. That would represent the total depreciation. So because we generally, in this format of a balance sheet, we generally list asset based on its original cost. So if your asset was purchased for $1 million, that's what would be listed in the balance sheet, $1 million. From that $1 million, then we would have a net amount. So the net amount would due to we taking out the amortization. So it would be the original cost minus the accumulated amortization to give us what would be net of the total asset or of that profit. So that would be a part of our long-term assets. That's what amortization. What about retained earnings? We talked about retained earnings earlier. So we say retained earnings will be part of our capital. Retained earnings would be part of our capital because it's that part of a profit that could actually be distributed to the shareholders, that is actually put back into the company, that therefore represents part of the capital. Of course, you know, cash goes first because it's the most liquid. So in this kind of how we are setting up the balance sheet, the most liquid items. So how about bonds payable? What would that represent?
Would it be a short-term liability?
It would be a liability, but not a short-term liability. So a bond is usually a long-term liability because it's usually issued over a number of accounting periods.
Oh, right.
So you have like a 30-year bond. So that would be a long-term liability. So it is a liability, but a long-term liability. And accounts receivable would be?
Short-term asset.
It would be a current asset, yeah. But anything else peculiar about accounts receivable? Accounts receivable is a current asset, and it represents the amount outstanding for company from its credit sales. It represents the amount outstanding for the company from its credit sales. The company will make sales either by cash or on credit. If that sale is made on credit, then that amount goes towards increasing the accounts accounts receivable. The accounts receivable. So that will go towards increasing the accounts receivable. Then we spoke about plant and equipment before. And so you notice here that it says plant and equipment at original cost. So it is telling you that you need to take away accumulated depreciation from this. Accounts receivable is where the company purchased goods on credit. If the company purchases goods on credit, that will go towards increasing the accounts payable. And of course, allowances for bad debt would be again company making an allowance from its receivable. So it has a receivable accounts receivable amount, and from that it make an assumption that a portion of it may not be able to collect, and that will be taken away from the accounts receivable amount to find a net amount. Then, of course, common stock, of course, would also be part of capital. Inventory would be a current asset. Preferred stock would be part of capital. Marketable securities would be a current asset. And investment would be another form of long-term assets. And of course, note payables also a current asset. So let's see if we can put this balance sheet together.
We don't see that blank page.
Huh? Are you seeing my blank page?
Yeah, we do now.
Good. All right, so we're going to start with a balance sheet. So first, we're going to start with assets, okay? And we're going to start with current assets. So since we're starting with the most liquid assets, we're going to start with cash at the top. That represents 10,000. We're starting with cash because we're starting with the most liquid. What would come next if you're looking at the most liquid? What would come next?
Accounts receivable.
Accounts receivable. Anyone else? What would be the next most liquid asset?
Oh, marketable securities.
Marketable securities.
And then accounts receivable, yeah.
And then accounts receivables. Okay. So the next most liquid asset would be marketable securities. These are securities that can be easily converted to cash. So that's why they're considered to be the most liquid of the other assets, marketable securities. It can easily be converted to cash. Next, we have accounts receivable. So you could convert your accounts receivable to cash. It's not going to be as able to turn it into cash as you can with a marketable security, right? There's going to be costs associated with it. You may have to, for example, give a discount, find someone who's willing to take your accounts receivable from it. The marketable securities, there's a market available for which you can easily turn that into cash. 1,000. And from this, we're going to less what? We're going to less the allowances for bad debt.
What did you say?
Huh?
What was the last thing you just said?
I don't remember.
You're writing it right now.
Allowances for bad debts. So, okay, so here we have accounts receivable. So from accounts receivable, we're going to take the allowances for bad debts to find net accounts receivable. Right? That's what we're going to put in our balance sheet. Is that what you're talking about?
Yes.
Net accounts receivable, which would be 42,000. Okay. What's next? What comes next? On our list, what comes next? Venture, right? Inventories, 66,000. So we have total current assets of 138,000. Okay, so what's next?
Is this total accounts receivable? Are you? I'm just trying to figure out how you calculated that. Oh, there is there is an inventory. Okay, never mind. I'm good.
Okay. So what's next? We have other assets, right? So we're just gonna put other assets. We have capital asset. We have plants. We have plant and equipment. Of 680,000. And then we have less accumulated depreciation, accumulated amortization of 300,000. So we have 380,000 for the net plant and equipment. Therefore, we have total assets of 5. Okay, let me just do I'm gonna do the liability section on another page. Any issue with this so far? No issue?
No.
Good. I'm just gonna do the liability section on another page. You guys can just continue going down your page. Now we've done the asset section. We're now going to do liabilities. Okay. So let's start with current assets. Sorry, current liabilities. If we start with current liabilities, what do we have as current liabilities here? have accounts payable. We have 35,000. What did we say accounts payable was again? Guys, what did we say accounts payable was?
Accounts payable is kind of like debt, right?
Yeah, it's a liability, so it's a debt. What do we say it is that it represents? What so that's represent what? Trade debtors, right? We said that when the company purchased goods for resale on credit, that's what goes into the accounts payable. So it represents our trade creditors. Notes payable. So notes payable is just maybe some form of short-term borrowings that a company may have done. May have issue commercial note or something. But it's not, or it could be a short-term loan from a bank. All right, so we have total current liabilities. $8,000. Then now we're going to go on to long-term liabilities. And long-term liability, we have bond of 130,000. What is the long-term liability, guys? What is the bond payable? Is it, how much is it?
136,000.
136. So we have total liabilities of what? 204,000, right? That represents our total liabilities. So how about our shareholders' equity? What we refer to as a capital. First, we have preferred.
What did you just write?
Shareholders' equity. Not clear?
No. It looks like there's an E in there above it. Like you just made a subtitle, a new subheading that said, you just said it, but I can't remember what you said.
Shareholders' equity.
Oh, okay.
Shareholders' equity. Yeah, it's a subtitle. So we just write in those things that are part of the shareholders' equity. The first one we're going with is preferred shares. And it's 1,000 shares outstanding. And those 1,000 shares is 50,000. So you can make note that it's 1,000 shares outstanding, but you don't have to. Then we have common stock. have common stock of 188,000, right? We have retained earnings of of 90,000. Total shareholders' equity
Monday.
total shareholders' equity will be 334,000. So the total liabilities and shareholders' equity would be the sum of 1 and 2. That should give us 5,800, which means our balance sheet actually balanced. Okay, any question?
None here.
Right, anything someone didn't understand that they want me to go back over? Right, guys, if you don't have any question for me, if you don't have any issue you'd like me to address, then I guess I'll see you all next week. Please try and watch the videos before class, and so that will help us when we're going through the questions. We can go even faster so that you can lead class even.
And what days are you posting the videos on? Sorry.
It will be by Saturday morning, the latest.
Okay.
All right, guys. All right, see you next week. Enjoy the rest of the week.
All right.
You too.
You
Thank
too.
you.
Okay, thanks.
Someone saying something?
Just saying bye.
Okay. All right. Bye, guys.
Bye.